Good Wednesday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pogamanik. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Ready?
Yep. I'm going to share my screen. While I'm doing that, if anyone is joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to ask your question live, we do provide a link to Zoom. If you click on, it's in the live chat. If you click on that link, it takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that, then you could ask your question live and direct. If you prefer to type your question, you could type it into the live chat on YouTube. Will's watching it, he'll read it back to me. While we're waiting for questions to come in and for more people to join us, we'll take a look at the pre-market report to see if we could get some insights on what's trading in the pre-market hours. And then we'll move on to the questions. If we don't get questions, I'll default to some questions we get over the emails and through the chat. Okay.
Perfect.
So pre-market report, these are stocks trading in the pre-market hours. I'm going to come down here and we see we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 91 stocks made our percentage gainers list, 33 on the decliners. So from this perspective, looks like we're setting up for more bullish bias at the open. I'm going to scroll up here and take a look at what's going on from the top level, across all stocks. This is a calendar view. And right now we're on July 19th over here. And we could see here, this is a breakdown of what's going on in the pre-market. So we got 514 stocks that are trading higher in the pre-market than the previous day's close and 257 lower. As far as volume, there's 106 million shares trading on up volume versus 44.6 million trading on down volume. And as far as dollar volume or notional value, $3.3 billion worth of stock trading on up versus $475 million worth of stock trading lower. Okay, so this is also indicating a bullish sentiment at the open. I'm going to come down here and we'll do one more thing. We see that this list consists of stocks that are low cap stocks, ETFs, leverage products, anything that's really listed on the major US exchange. If it's trading in pre-market hours and meets certain thresholds that we set, can make this list. And to narrow it down, we could use the filters above to look at a smaller group. And I'm going to use this one as an example in ETF. And click on this and we get a drop-down menu. And it's a list of ETFs to choose from. We have broad-based ETFs, sector ETFs. I'm going to select the first one, SPY, which is the S&P 500 ETF. Click on that, and the list below got filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. Here we got 17 stocks made our percentage gainers list, 4 in the decliners. And that also indicates a more bullish sentiment at the open. We do have some earnings coming in. So I see, Goldman reported. We have, what is that? I'm not sure what that stock is, Elevance. But we do have earnings coming in. So this little E here is saying that there was an earnings either yesterday after the market closed, or just reported today prior to the market open, and these stocks are reacting to some of that information. So, so today, let me see if there are no questions. Will, I'll just kind of move on. If you have any questions, I'll take them now.
Nothing's popped in yet.
Okay. So there was a question. Let me see if I could frame the question, and it had to do with how would you go through a thesis and set up a trade. So when we do an analysis on certain strategies, right? So go to the options chain, and we'll talk about options. With options, when you set up strategies, prior to doing it, you do have some kind of a thesis or forecast or an idea what you intend to do. And then you take that and start using that as the basis then to check the option markets. All right. So first, I'll bring up my pen. And the model you run and the analysis you do has to match up with what your intent is. Okay. So let's just say, real estate, right? If my intent is to do the, carry trade, right? If I want to do the carry trade, basically buy it, rent it out, and use that cash flow and hope that it appreciates over time and that rent goes up. Well, then what I need to do is, analyze, the rent, the cost, maybe, the interest rate, right? And see if it makes sense. Does this carry trade make sense to me? You run it through this model that you could create, right? So you take your revenue from one side, which is your rent, then your cost of carry, which could be your interest rate, your insurance, your taxes, your maintenance. You compare the two, you take the difference, then you might forecast, let's say, you forecast some kind of, rent, growth, appreciation, and so forth. That will go into your formula, and then you can make a decision if this is a good investment for you. But you could also use it for different purpose, right? What if instead of the carry trade, you just want to flip, right? So you want to flip the house because you think, this house is, let's say you're a flipper, and you think that, you could renovate the house, you could buy it, right? Your intent is to buy it, right? Renovate and then sell it. Well, if that's what your intent is, then you don't need to, then you don't need this model, right? Because you're not intending to buy, let's say you saw a house in LA that looks great, and you're like, this is just like awesome land. The house is old. I'm going to wreck it down, build this beautiful house, and sell it for millions of dollars, right? Well, that means you don't want to rent a mansion in LA. That's not your intent. You want to build it and sell it. So then, right, you need to figure out the cost of buying it, the cost of renovating, and then what you could sell it for. That's your model, right? Because now your intent is different, and you're going to use a different set of inputs, a different model, and so forth. And the same thing will be with options, right? When you're analyzing it, what is your intent with with the options? And that is the model that you got to use. So when we talk about, option strategies, right? You could look at options and trade volatility. Then then you got to forecast volatility, use an option pricing model to say, based on my forecast, what should this option be worth? And you trade the volatility, right? You could forecast the carry cost, right? Interest rate, dividend forecast. You could take, because you could put on a conversion reversal. If you think that the dividend is unknown, if the market is forecasting a dividend that is too high or too low, well, you could put on a conversion, you could put on a reversal, and then you're not exposed to you hedged off the volatility risk, the decay risk, you hedged off the directional risk, and you narrowed it down to the carry risk, right? The cost of carry, which is the interest rate and the dividend. What about if you're just looking at an event, and you wanted to price in an event, right? So the idea here is, let's say you're looking at a stock, and the stock is, let's say, $100. And if you think in your analysis, you run a forecast, your analysis, and you think, okay, this is what my model says. That my model says that in the next 15 days, so you find an expiration that covers that 15 days, the stock has and let's just say you're looking at the 110 call, right? 110 strike call. And your model says, okay, there's something that's going on that I think there's a 20% chance that the stock will rocket up 30%. 20% probability that we are up 30%. Sorry. And 80% chance it's not, right? 80% chance that probability, let's just say, is down or moves a little bit. Okay. So if this is your model, this is what your model is telling you. Okay. Then you have to take that model and say, well, I'm going to base my strategy, based my options, based on what I'm buying and selling, structuring it on that thesis, that assumption. So you're not looking at volatility anymore, because you don't intend to trade volatility. You're not going to be trading your gamma, your delta. You're not looking, even if implied vols are low or high, you want to see how the options are priced, and do you have a theoretical edge based on your thesis versus the market prices. So for example, if there's a 20% chance that the stock will be up 30%. That means that there's a 20% chance that the stock is going to go to $130, right? Up 30%. So if the stock is at $130, then this call, right? There's this call should be 30, right? At expiration, because that's parity. If at expiration, if this is your, remember, this is your model, and saying 20% chance that, my model says we're going to be up 30%. That means that this call at parity will be $30.
And parity would be 20, right? 130?
Huh?
110 call?
Oh, sorry. It'll be 20. Yeah, sorry. Yeah, $20.
No worries. That's the only thing I've gotten wrong. Right.
Yeah, very good. Thank you for correcting me. Yes. 20. Yes.
Well, I had to double check myself.
I was looking at this
to make sure.
Yes.
Yeah.
Yes. It will be worth $20 because that's parity, right? Very good. Thank you all. 130, right? Above 110, that's $20. So this will be $20 at expiration because that's parity. And let's just say 80% chance you think it's not going to make it anywhere near this 110 strike, So that means that if the stock's below 110, then this is worth 0. Right? The option will expire worthless, stock below 110. So then you got to figure out, well, if this is my thesis, if this is my theory, then what is the call price and what do I think the call price should be worth, right? Well, if you think that there's a 20% chance, that it's going to be worth $20, an 80% chance, right, that it's worth 0. Well, this is saying that it's going to be worth $4 plus 0, right? Is my math right there, Will? So you think that this call fair value is $4, right? That's what you think, like, well, I'd be willing to pay up to $4. That's my break even on my thesis. So you could be wrong, and it could be down. You don't know where the stock's going to go. If you're right and you paid $4 for it and it ends up being 20, that's a huge win, right? If you're wrong, then you lose $4. But your fair value, theoretical fair value, is $4. And you could compare that to the market. Maybe if the option is priced at $1, well, that could be a pretty good deal, right? Because if you're right, about, your thesis and it hits that 20%, well, now you paid $1 for something that could go up to 20. And if you're wrong, you lost $1, but you really thought it was worth $4 anyway, so you didn't lose as much as you thought. So you could see that a lot of this is based on the thesis that I'm developing. So the strategy itself, right, is based on initially my forecast. So no matter what I do, wherever, even these trade cards, I'm only looking at these trade cards after I develop the thesis. And then I'm like, well, let me see where the long call, are there any extra edge in the long calls, debit iron condor, because I've already developed a thesis about the stock. But you could see here that this, if I'm looking at, and I think that just the implied volatility, maybe I think the implied volatility is low, and I calculated the implied volatility. Well, then this doesn't apply, because implied volatility is the daily fluctuations, right, of the stock up and down. It's not waiting for the stock. It's not holding It's not a carry. It's not holding an option and waiting for it to go all the way up, right? Because that's not what volatility is. Volatility is the daily fluctuation. It's how much does it move up and down on a, in between now and expiration, right? That's what you're looking at. That's the volatility. So that you would have to measure it in a different way and say, if I intend to trade the stocks, trade the options gamma, right? And trade and hedge my deltas at the end of the day, or whatever my strategy is, then this doesn't matter, because I'm not waiting for the stock to just go someplace. I'm going to be rehedging it, and I'm going to try to make up for the daily decay by scalping the stock. All right, that's a different model. And if that's what you intend to do, that's the model you should look at, just like over here, right? You have two different models, and you should look at that model. If I think that my dividend, right, forecast is really good, and my dividend forecast says this, but the market is implying that, well, then that's the model I'm looking at. And then I'm looking at how do the conversions, reversals set up in the marketplace. Okay. So these are very important. So when we do any type of trade setups, right, and if we look at the best way, well, first we have to have the thesis, right? And then we start looking and analyzing the markets as well, because under what thesis are we working off, right? Just like in real estate, well, what thesis are you working on a flip, on a renovation, on a repurposing of a some kind of real estate deal, subdividing, or just buying it and renting it and carrying it? Like, under what thesis are you working on? And then we have to go to that model and run the model to see if it makes sense, or what are the models telling us about the risk, the rewards, the pricing of it, and so forth. So when we take a thesis, you would need to know, first of all, what is your thesis, right? What is your thesis? And all the elements that you need. What is your time horizon? If you're looking at just a directional move, right? If yours is based on some kind of a directional move, well, you'll need the time horizon, the target price, the probabilities of it going there. And then, when we have all the elements that we need, then we could start looking at strategies that are, in line with that thesis. Okay, so you need those, because otherwise you can't set up a strategy without the thesis, right? I can't just go in there and say, well, show me a strategy that fits this. Well, what is this? I need to know what this is. What are you attempting to do? Right? What are you trying to do? And can we use options, right? Or can we use a strategy there that makes sense, gives you a certain edge, gives you a good risk reward based on those, targets, estimates, forecasts that you're creating. All right. So whether it could be a calendar spread, it could be a bull call spread, it could be a diagonal spread, it could be many different things, but we still need those other pieces of information to start comparing it.
Hey, D?
Yeah.
It came in a little late, delayed. I'm sorry about this. Rob was asking, so in the example you're showing, I would want to be on the sell side for premium of the 80% chance, or reduce the price of the call in some other way, like a spread. That's what he was asking.
I'm not sure what that means. So when you're saying an 80%, right? When I'm saying 80%, okay, there's probabilities and then there's payoffs, right? Probability is just, what are the chances of this happening? Okay. What do we think? What do we estimate the chances of this happening? Or the frequency of something like this happening. But the other part is, well, what if what are the payoffs, right? You need to know the payoffs, because if there's a 20% chance of something happening, but the payoff is very big, right? There's an expected value. There's an estimated value to this bet. So you don't want to just jump on something because it says 80%. Well, what are the payoffs? If you can't assume the payoffs are exactly the same for an 80% and a 20%, right? You need to know what they are. Of course, if an 80% chance that you're gonna, make or lose $1, 20% chance to make or lose $1, then you go for the 80%, because then your expected return is positive. But if this 20% hits, what is the payoff? So look, you could see here, right? That's why I wrote it out here, that it's $20. If this 20% chance hits, this is worth $20, right? And if this 80% hits, you lose, let's say, $1, right? So you're here based on this. You want to be theoretically buying it at $1, even though that there's an 80% chance that you are gonna lose. The expected value, expected return is positive, because when it does hit, this is your payoff. This is important, right? This part is important. You can't just look at this. You shouldn't be doing it. If you're doing just that, then you don't understand. Then you have to relearn everything, right? Because you can't just do that. That's a bad practice if you're not looking at the potential risks and rewards and payoffs. So like I wrote, I put it out here, right? There's 20% chance, but if that happens, that means the payoff is very big, right? So for the $1 that you're risking, if this happens, the payoff is very big. And if this happens, then the loss is $1. Even though there's a higher chance of this happening, the loss is $1. So you're not, what you potentially can make is much higher than what you're risking, right? And then you have to run that through the equation to make sure that there's a positive expected value, EV, right? Which in this case, if we paid $1, because the expected value over the long term is 4, right? This bet would be worth 4. So if you're paying $1 for something that in theory is worth 4, you're getting a discount. Okay.
That's very helpful, D. We're right up against the opening. We did have a question from Sarush. I'll copy and paste it, and maybe we can look at it tomorrow. Sarush is asking, question, is there a strategy builder backed with historical results? For example, creating an iron condor with a 20 delta and seeing how it would perform over a certain number of years. He's wondering or a certain number of dates, whatever. He's wondering if there's something like that available. Maybe we can answer that tomorrow.
Okay.
Awesome job, Dima. Thanks, buddy.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, communities. Everyone have a great day. Bye-bye.
Bye, everyone.